Silver CVOL just exploded to 115. The CME Volatility Index jumped 60% overnight. For perspective, the normal range sits between 15 and 40. Anything above 100 is rare. It signals extreme instability and usually points to structural stress somewhere in the system. Here's why this matters right now. Volatility is currently 10 points higher than when silver hit $120 just 3 weeks ago. The options market is pricing more explosive movement at $73 than it did at the all-time high. That alone should get your attention. Either you verify primary sources or you don't. Either you read settlement documents or rely on headlines. Either you're here for hard data or for debate. The people who verify don't need convincing. The ones who don't rarely survive in these markets. If you see accounts reposting daily updates under similar names, check the handle carefully. Names can be copied. Handles cannot. Silver Western Spot, $73. Silver Western Futures, $73. Shanghai Spot, $86. Shanghai Futures, $88. A $13 premium between East and West is holding, even as Western paper pricing compresses. Gold Western Spot recently traded near 4,880 and is now sitting just below 4,900. Meanwhile, mainstream commentary is declaring the metals bull market finished after a 40% correction from recent highs. But something larger broke yesterday in the broader market, and it explains why metals were hit so violently. U.S. equities experienced massive two-way swings within hours. That doesn't happen in calm, liquid markets. The S&P 500 first dropped 1%, erasing roughly $600 billion in market cap. Then it reversed and rallied 1.1%, adding approximately $650 billion back. The Nasdaq fell 1.34%, wiping out over $530 billion, then rebounded 1.43%, restoring nearly the same amount. That kind of intraday whipsaw is classic forced deleveraging. It happens when funds face margin pressure and liquidate whatever they can sell fastest, regardless of fundamentals. Banks tapped the Federal Reserve repo window for $11 billion, $8 billion in treasuries, and $3 billion in mortgage-backed securities. This is the first usage since early January, when $22.8 billion was drawn during the historic silver squeeze. That facility doesn't get tapped during orderly conditions. It appears when liquidity stress is building beneath the surface. When gold, silver, and the Nasdaq all fall together, the market isn't pricing fundamentals. It's pricing cash demand. That's the fingerprint of a liquidity event, not a normal pullback. In healthy markets, stocks fall and gold often rises as a defensive asset. In liquidity crises, everything gets sold to raise dollars. The US dollar index strengthens and becomes a wrecking ball across asset classes. What we're seeing looks like a broad deleveraging wave. Large players were long multiple assets with borrowed capital. Something triggered selling in tech. To cover those losses, highly liquid positions like gold and silver were sold. Charles Kindleberger, in Manias, Panics, and Crashes, outlined the mechanical stages of financial crises: expansion, euphoria, insider profit-taking, then panic as leverage unwinds. The panic phase is marked by indiscriminate selling. Fundamentals temporarily don't matter. Liquidity does. This pattern is visible again. Historically, metals often sell off before equities during liquidity stress. That dynamic was visible before the 2008 financial crisis. In forced selling environments, quality doesn't matter. Liquidity does. Now look at the macro stress signals. Dollar strength rising, VIX rising, Treasury yields falling. That combination historically precedes equity drawdowns, commodity weakness, widening credit spreads, and systemic stress. It signals a defensive regime forming. This isn't speculation, it's observable data. The FOMC minutes released tomorrow. Thursday and Friday bring additional high-impact economic reports. These events create liquidity windows where large positioning shifts occur. Expect heightened volatility over the next several days. For short-term traders, here's the technical framework. Open the silver daily chart. Mark a horizontal line at the low of Wednesday, December 31st, 2025. Now look at the raid on that level on Friday, February 6, 2026. The candle body closed back above the December 31st low. That confirms a swing failure pattern, inherently bullish structure. On lower time frames, an inverse head and shoulders is forming, though displacement hasn't occurred yet. Displacement means a strong, impulsive move with volume that confirms conviction. The February 6 candle now acts as a key reference level. The immediate support zone sits between 72.6 and 70. Price recently bounced there. That zone is support, not a buy signal, but a framework. If price wants to move higher, body closes should remain above that range. A confirmed close below 72.6 to 70 would signal significant weakness. If support holds and displacement appears, upside targets could be 75, then 77. If a body close breaks that zone, downside opens towards 67, possibly even below the February 6th wick. Now connect that structure to the options market. Silver CVOL at 115 does not predict direction. It predicts turbulence. It signals that traders expect major movement over the next 30 days. High volatility means uncertainty is extreme. With March notice day approaching and macro catalysts ahead, the market is bracing for aggressive repricing. Direction remains open. But the turbulence is already here. Open interest hasn't fully rolled forward yet, and the tension between taking delivery and rolling contracts is creating potential stress within the exchange. At the same time, a deep-pocketed participant has been steadily accumulating December gold call spreads on COMEX, blocks of 15,000 to 20,000 contracts at a time. For those calls to finish in the money by late 2026, gold would need to surge dramatically from current levels. The buying began after gold reached 5,600 in late January. Even when prices slipped back under 5,000, the accumulation continued. Open interest in that strike is now around 11,000 contracts. That tells you something important. Despite weak price action and negative sentiment, significant capital is positioning for an outsized upside move. Context matters. In September 2020, JP Morgan agreed to pay $920 million to resolve charges tied to precious metals spoofing and market manipulation. Case number 1:19:CR-00438. Two senior traders were later sentenced to federal prison in 2023 for those activities. This isn't speculation, it's a matter of public record. Yet concentrated short exposure in metals continues to show up in weekly CFTC data. Understanding that history helps frame today's price behavior, especially during periods like Shanghai market closures, less as fundamental collapse and more as tactical positioning within a paper-driven structure. Hyman Minsky wrote about how instability builds during calm periods. Leverage accumulates quietly, and the shift from stability to crisis happens abruptly when forced selling hits and liquidity disappears. Deleveraging comes first, often pushing prices far below fundamental value. Opportunity tends to appear only after the forced sellers are exhausted and normal supply-demand dynamics reassert themselves. Long-term physical holders understand this distinction. They are not chasing short-term volatility. They are focused on what they see as a structural supply deficit that paper positioning cannot permanently suppress. Sentiment indicators currently show extreme pessimism around silver. Sharp advances rarely consolidate neatly, but the broader trend structure remains constructive. Historically, bull markets tend to advance amid skepticism. When fear spikes and commentators declare the move over, that often lays the groundwork for the next advance. Extreme sentiment can mark the reset phase before continuation. Some commodity analysts project silver could reach $120 to $180 this year, citing two drivers: sustained industrial demand from solar expansion, AI infrastructure, and electronics, alongside a potential remonetization theme as central banks diversify reserves. Meanwhile, the market is reportedly entering a fifth consecutive year of supply deficit, with an estimated 200 million ounce annual shortfall. Global portfolio allocation to silver has hovered near 0.03% in recent years, compared with roughly 0.06% during the 2011 peak, suggesting room for capital rotation if conditions shift. That said, the bearish case deserves equal scrutiny. In liquidity events, paper markets can overwhelm physical fundamentals in the short term. A strong dollar, rising volatility, VIX, and higher yields can trigger systematic selling. The Fed's repo usage could normalize quickly without broader contagion. Upcoming FOMC decisions and major data releases may spark another wave of liquidation. Technical support in the 72.6 to 70 zone could fail, opening the door to 67 or lower. A spike in CVOL may subside without producing the explosive move some anticipate. Here's what the broader landscape currently shows. CVOL around 115, reflecting expectations for elevated volatility. Banks accessing roughly $11 billion via the Fed repo facility, the first notable usage since early January's squeeze. A strong dollar, elevated VIX, and rising yields, a trio that has historically preceded broad risk asset stress. A massive intraday swing in the S&P, reflecting forced liquidation dynamics. Persistent December gold call open interest near 11,000 contracts despite falling spot prices. A sustained Shanghai premium of about $13 even as Western paper markets sell off. A confirmed technical swing failure on February 6th with clearly defined support levels. Sentiment at extreme fear readings. Silver allocation at just 0.03% of global wealth, well below prior cycle peaks. China closed while COMEX trades through Friday, creating a temporary structural window. The options market is already pricing significant turbulence over the next month. The repo facility suggests at least localized funding stress. Technical levels are clear. Sentiment is washed out. Multiple high-impact catalysts are imminent. The issue isn't whether volatility is coming. The volatility index suggests it is. The real question is whether you understand what deleveraging does to markets. It produces price distortions disconnected from fundamentals. Those distortions often reverse sharply once selling pressure exhausts itself. Approach this with discipline and independent verification. The legal records are public. The charts are accessible. Repo data is transparent for anyone who checks. Don't rely on commentary alone. Confirm the facts, study the levels, monitor the premium, and pay attention to timing. Markets are competitive and unforgiving. If you don't recognize the setup, you risk becoming part of it. Stay alert. This phase may be only the start of a larger move.